and it's kicking off, say, $10,000 to $20,000 in dividends each year, all that money is going to the nursing home. Hi, this is Jeff Mersacci, the Plain English Attorney, and today we're going to talk about revocable trusts versus irrevocable trusts. And we're going to focus on three different areas: purpose, use, and taxation. All right, so let's start with purpose. Revocable living trusts are fantastic. They are primarily used for estate planning. The idea is we're putting together a revocable living trust for clients as a way for them to retitle their assets, change the beneficiaries to be the trust. It ends up that their estate is in this trust instead of in probate, so that it can get administered and handed to the beneficiaries more efficiently, with less expense, without delays, and it just becomes a much, much easier way to transfer an estate to your loved ones after you're gone. At the same time, its purpose is to take care of you if you become incapacitated. All right, so that's the purpose behind a revocable living trust. It's not for lawsuit shields, and I end up having to go over this with a lot of my clients when we're going through exactly what a revocable trust is. They're signing their engagement agreement, and I go through this. Look, just because these assets are in a revocable living trust doesn't mean if you get on the highway and you rear end somebody and, oh, you can't sue me, all my assets are in a trust. No, in a revocable living trust, you're going to keep control. So it's used for estate planning. That's what it's for. All right, so now let's talk about two different kinds of irrevocable trusts that we use a lot when we're doing Medicaid and other care assistance planning. We typically have the irrevocable family trust and the irrevocable property trust. Let's talk about the irrevocable property trust first. The irrevocable property trust, the purpose is to hold real estate, assets that will appreciate greatly or are already highly appreciated in terms of cost basis. We'll talk more about that when we get to taxation. But in general, for most of my clients, it's just real estate that goes into this trust. Now, it's irrevocable. You need to have another person in charge as the trustee, but my clients are retaining certain rights over the property, and it's for some very specific reasons, and we'll get to that. So it's, again, for just highly appreciated or appreciating assets. Most of the time, we're just talking about real estate. And then the irrevocable family trust, this is like the best lawsuit protection, spend down protection for Medicaid that you're going to get. That's what it's for. It's for all of your other assets like stocks, bonds, mutual funds, cash, bank accounts, CD. All the liquid stuff is going to end up in the irrevocable family trust. And it's used to keep those assets off the table. Again, there's a separate trustee who's in charge of it. And in this instance, when we use this for planning, the clients don't have any right to any of the assets that go into the family trust. It's entirely in the hands of the trustee. Again, the main reason is to get these assets off the table for Medicaid. So again, we have the revocable trust, the irrevocable property trust, and the irrevocable family trust. So that's the purpose for those trusts. The irrevocable trust, usually we're using them in a Medicaid planning context, but they also end up providing lawsuit protection and other things like that. So use. With a revocable trust, the person or people setting up the trust, they're typically the trustees. They're in charge. They get to do anything that they want to do with their assets the same as if it was titled in their own name. All we're really doing when we're using this revocable trust is to avoid issues of incapacity and assets having to go to probate court when they pass on. So other than that, they keep complete control over everything. So there really shouldn't be anything other than maybe a few minor inconveniences of certain types of paperwork. And I have a lot of videos already out there dealing with real estate. If you're selling or refinancing or buying real estate into the trust, that there are certain issues that you have to go around. But it's paperwork. It's not really affecting the control that the people setting up the trust have. It's not affecting their authority to do whatever they want to do. So the revocable trust, again, purely an estate and incapacity planning tool. The irrevocable property trust, we're moving real estate into this trust directly, indirectly, however we're going to do it, in order to protect it from a Medicaid spend down. Now, if you take the property and just move it into the irrevocable property trust, it's a transfer that's got a 5-year look back period. Now, again, there may be some ways around this. I'm not going to get too deeply into that. That's a whole other Medicaid planning issue. But you get to keep control in terms of living on the property for your lifetime, but you also end up with the responsibility for the upkeep and the taxes and things like that. You can no longer sell that property, which, if you could sell that property, it ends up being on your balance sheet when you're applying for Medicaid. So the idea is, no, we're taking it off the balance sheet when you're applying for Medicaid without having to actually give up the land or sell it and spend down the money. So your trustee's in control of it, but you're retaining rights. Another big right that kind of has to be there when we get to the taxation issues. You have to keep the right to retain any income that's generated. So if you've got 5 houses, one of them's your primary residence and we've moved it in there, but the other 4 are rental properties, that's kicking off income. That income must be yours in this particular type of property trust, even though it's irrevocable. So when that income comes in, it's got to go in your pocket. And I hear a lot of people say, oh yeah, well, that's great. The problem is when you get to the point of needing Medicaid, that income still has to come out and go to you. So it's paying the nursing home when somehow or another it might have been retained, and all it's doing is reducing the portion that Medicaid has to pay. So, excuse me, in a lot of instances, you don't want that property to produce income. And if it is, then we've got to really examine how we're going to be managing that, because it's the net income. There might be other things that can be done with the trustee in order to reduce what's actually coming out of the trust, because, again, all you're doing is reducing Medicaid's bill. All right. The irrevocable family trust, purely in the discretion of the trustee. And the way we set this up for Medicaid planning, there's no right from the people setting it up. Now, we're just going to say it's the parents and one of the kids is the trustee. So the parents, it was their money. It's no longer their money. It's moved into that irrevocable family trust. And then 5 years after that transfer in, it cuts off Medicaid's ability to say, hey, that's yours, you have to spend it down. Or again, if it's past that 5-year mark, it doesn't count as a gift against your Medicaid application. Now, there are, again, some very creative ways. We'll have other Medicaid videos, and hopefully soon we're going to have another actual course on Medicaid planning that would be available to go through. There are ways around that 5-year period, but in general, you're putting that money in and it's like you're walking away from it. Well, how's that any good? Because if it's your kid who's the trustee and you trust them to give you whatever money you need, they can take the money out of the trust, put it into their own pocket, and then turn around and pay for things for you or give you money. That's how that works. But in use, that family trust has no more ties to you once you've set it up and you've moved that money in. It always has to go through your trustee, and you have to trust that they're not going to just ignore your requests for money. So that's how these 3 trusts are used. Again, revocable trust, wide open, still yours. You do whatever you want with it. Irrevocable property trust, look, you can't sell that property, but you have the responsibility to keep up the property, pay the taxes, but you get the right to live on that property and do what you want in terms of managing it, and you have to get all the income. But then the family trust, that's the more extreme. No, we're just moving that money in and you no longer have a tie to it. All right, so now let's get to taxation, the third part in examining all of these trusts. With the revocable trust, we're going to talk about income. Hey, any of your assets that are in there, the income stays the same. It's a, quote, pass-through entity. It's see-through. It's as if it's not even there. You don't need to file a separate tax return for your revocable living trust because it's revocable. I've got other videos on this. Just use your social security number. If it's a couple, hey, just when you're transferring your assets in, just use the social security number that's already on it. It's fine. So for income taxes, it's see-through. Capital gains taxes upon death. Let's just say it's an individual. Let's keep it simple. They purchased a house for $200,000, put it in. By the time they pass on, it's worth $500,000. The trustee goes to sell the trust. Do they pay capital gains taxes on that $300,000 gain? No. Your cost basis bumps up to the fair market value on the date of death. So when they turn around and sell it, usually, like if you sell it within a year and there weren't any wild changes to property values in the area, they're just going to assume that the sale price was the actual fair market value price, and it's done, no capital gains taxes. All right, let's talk about now the irrevocable property trust. Okay, this is what makes these trusts so effective when it comes to things like Medicaid planning. The irrevocable property trust allows you to keep the ability to live on the property, the right to all of the income. You keep the responsibility for paying the taxes and expenses and insurance and the other things related to the property. Because you have those things, you're going to be taxed on the income when it goes in. In terms of estate taxes, it counts as part of your taxable estate. By counting as part of your taxable estate, you also get that same, they call it a stepped up basis, that bumped up cost basis on the date of death. So again, if you bought the house at $200,000, you moved it into this irrevocable property trust, passed on, and it's at $500,000 when the trustee sells it, they're not going to have to pay capital gains taxes on it either. Well, okay, then what's why use this then? Because that's one set of rules regarding taxation. It's another set of rules regarding control for Medicaid and other benefit planning purposes. So it's enough control that it becomes part of your taxable estate, which means you get that capital gains credit bump up. But at the same time, under Medicaid's rules, that's not enough control and ownership to say it's your asset. It's on the table when we examine everything for your Medicaid application. So that's why we put that in there into the irrevocable property trust. So it's off the table for Medicaid, but you get the capital gains bump up. The irrevocable family trust, how's that handled for income taxes? This is where it gets to be a little more complicated when you're doing the planning. But look, when you're talking about an average of like $10,000 a month for nursing home care, you deal with the complications that may come along with putting it together for taxes. Because the family, it's really mom and dad putting those assets into the irrevocable family trust. If it's invested in, say, stocks or bonds or mutual funds, whatever, and there's dividends, well, that's taxable income. If stock was sold, there might be capital gains taxes. Somebody's got to pay those taxes. There has to be a 1041 tax return filed for the irrevocable family trust if there's any kind of income or capital gains. But that doesn't mean you have to pay it at the trust tax rate. So follow me with this. There are two options. You file the 1041 and you declare the income and the capital gains on the 1041 and you pay it at the trust tax rate, which tends to be a lot higher than individual tax rates. Or because the trustee has full authority to take the money out and put it in their pocket, you could also simply say no. That income and capital gains taxes goes on that trustee's individual tax return, their 1040, and then they can just take out enough money to pay that additional tax. And if the tax is, usually it's significantly lower to pay it at the individual rate than the trust tax rate, you just file the 1041 with zeros in it and say, hey, all the income has been attributed to the trustee and they're accounting for it on their taxes. So that's the way the income taxation works there. Well, what about estate taxation? It's not part of the taxable estate anymore because it's been moved into that trust. Now, there's a caveat there. There's a 3-year, quote, look back period in terms of estate taxes and whether or not it counts for your estate taxes once it's gone in. Okay, but after that period, it's not part of your taxable estate. If it's not part of your taxable estate, then it doesn't get that capital gains bump up when they sell the stocks. There was no attachment to parents when they died in order for the law to say, yeah, they get a bumped up capital gains tax basis. The cost basis just bumps up to fair market value. That does not happen with the irrevocable family trust because there wasn't enough control. Well, why wouldn't you do that? Well, because if you have $500,000 in an irrevocable family trust and it's kicking off, say, $10,000 to $20,000 in dividends each year, all that money is going to the nursing home. No, you don't do that. So, yeah, you have to make a kind of tax decision up front If you had put those stocks into the irrevocable property trust, then all of that income is going to have to go to the nursing home, and that's not what my clients usually want. So yeah, we deal with whatever the capital gains taxes may be in the irrevocable family trust after the parents pass on. Yeah, you don't get that bumped up tax benefit, but at the same time, the income generated, the dividends, and that doesn't have to go to the nursing home. So that's how those trusts work with taxation. With a revocable trust, completely see-through. The irrevocable property trust, also simply see-through. If there is income being generated by rental properties or whatever, the parents still put it on their 1040. The irrevocable family trust, no, that doesn't belong to the parents at all anymore. So it's either doing a 1041 and paying the taxes and declaring the income on the 1041 at the trust tax rate, or the trustee can have the income and capital gains and whatnot put on their 1040 and file a 1041 that says, okay, it's zero, all the income's attributed. But you don't get the stepped up cost basis for capital gains taxes. So I hope you found that information on revocable versus irrevocable trusts useful. As always, please subscribe to the channel. It really does help us out. And leave a comment that you subscribe to the channel and let us know what are some other videos you might want to see and what information you might want to get. As always, please stay safe, plan ahead, and enjoy life. And whatever you do, make it a great day.